So yeah, guys, thanks for joining us. Really appreciate it. It was one of the highest registrations we've had for this for our webinars. If you don't know, my name's Chris. I'm the co-founder of UK Homes Network. We are the UK's first social media platform for the property industry. So it's a space where you can connect with other property professionals, talk about what's happening in the industry, and also find deals potentially for it. So if you want to download the app, you can go to your app store and search UK Homes Network, and you can create a profile. It takes a couple of minutes, and begin networking straight away. Obviously, Roma Finance are one of our partners at UK Homes Network and have been sharing some incredible content within the network around property finance, what's happening with development finance, bridging loans, that kind of thing. So, Scott, are you back with us?
Hi, Chris.
Great. So yeah, Scott, if you could just give us a bit of introduction, that'd be great.
Fantastic. So good morning, everybody. My name's Scott Marshall. I'm the founder and the managing director at Roma Finance. We've just celebrated our 15th anniversary. We are, I suppose, one of the largest non-bank lenders now in the UK. We complete anywhere between 50 and 120 transactions a month, supporting, and our whole raison d'etre, our whole mission is to lend money to people that are using our money to add value to property or create income from property, and effectively, ultimately, create wealth for themselves and their families through property. And we are here to support that as a business, and that's our mission. And so everything that we do is around understanding the person, understanding their background, understanding what they want to do, understanding their objectives, and how our money is going to help them to do that and grow their property, grow and help them on that journey. We've got under management just over now £200 million. We've got around 550 live loans at the moment with people that we're helping in different ways, which are anything from a ground up development of 10 houses to people that are more experienced, to the sort of doer-upper fix and flip of a terrace house, to large HMOs on buy-to-let mortgages. So there's a real range of kind of what we do, but ultimately it's anything where the customer is adding value to or deriving an income from property in the UK. The majority of what we do is residential, but we do some commercial as well. And within the business, we employ just under 70 people. So there's a fairly large business, and we're growing. And in terms of where our money comes from, we are an institutionally funded business with funding lines. Obviously, a lot of our own money in the business as well, but we have funding lines from some of the best known banks and building societies in the UK. And so you can imagine the kind of due diligence that we've been through as a business in order to get money from those institutions. And in addition to banks and building societies and our own money, we also have money that comes from Greater Manchester Council, and we have money that comes from the British Business Bank as well, among others. So you kind of get a flavour for the type of business we are. We are not a regulated lender because we don't do regulated business. But even though we're not a regulated lender, we very much behave as if we are a regulated lender, and that kind of permeates and runs through the ethos of our company. And as a result of that kind of philosophy, I think within the bridging and development industry, roughly 12% of all loans are in default across the industry. Our default rate is materially below 1%.
Wow.
So, that's one of the reasons why big institutions, local authorities, government like to back our business, because we don't represent a reputational risk to them, their members or their shareholders.
Fantastic. Thanks, Scott. We're going to we're going to dive into some questions in a minute, but obviously, guys, this is a totally interactive session. So if you do have questions for Scott or myself, please do put them in the chat, and we'll work our way through them towards the end. And if there's anything that's particularly pointing to what Scott's saying, we'll obviously head that off as soon as that comes up. But what I was going to say, Scott, is one of the things that really impressed me about you guys as a lender is that lenders sometimes, not always, but can be quite detached from the rest of the industry. And the sort of philosophy you guys have built is that you're very much boots on the ground, very visible, very engaged with the industry. So I've done a lot of networking in the last 6 months to try and push UK Homes Network. And I can say without fail, there hasn't been a networking event where there hasn't been some representation to Roma, much to the annoyance of the other lenders. But I think from a developer's perspective, that's key, isn't it? Because that means that they can build that trust with you and ensure that you are there to support them through that journey. Because it's not just about lending them some money at the end of the day; it's ensuring that development's a success.
Yeah, I think you made some interesting points, and there's obviously there's a difference in the relationship that you need with a lender for different types of products. So, if you take at one extreme a residential mortgage, okay, you do a residential mortgage based on your affordability. You take the money on day one, effectively, or day zero, and then you set up direct debits to pay your residential mortgage every single month. You should have no real contact with the lender, because the only time that you'll speak to the lender is if there is a problem making payments, and then you need some help and you need some support because you've got some challenges. Okay, a bridging loan and a buy-to-let mortgage is not that dissimilar. You get the money on day zero, you make your payments, you only speak to the lender if there's a problem during that time frame. Okay, a bridging loan, where you've got a single bullet loan, so you get the money on day zero and you repay month 6, month 9, month 12, however long the loan is for, again, is not that dissimilar. The good lenders will have various touch points with you, typically, with 3 months to go, 6 weeks to go. There'll be a welcome call at the beginning, but it's largely transactional, that relationship. A loan where you are taking drawdowns, whether it is a light refurbishment loan, whether it's a ground up development loan, and you're taking drawdowns from the lender during the life of that loan, you absolutely need to build a strong relationship with the lender, and the lender needs to build a strong relationship with you. Okay, so if I think that, let's say that we're doing 75% loan to cost on a project. Okay, you've got a cost of say £1 million, and we're doing £750,000 as a facility, which is drawn down, let's say £100,000 a month, just for argument's sake. Okay, you've got to, as a borrower, you've got to know and have faith and build a trust and know that we're going to be good for that £100,000 a month. And we've got to know, like, and trust you that you're capable of delivering the work successfully in order to warrant giving you a further £100,000 each month. And so that relationship that you're building and cementing with a lender from day one is really important on a drawdown loan. And I think there's a massive difference between a loan where you're taking drawdowns and a loan which is a single bullet transaction. And you've got to have a strong relationship with a lender, because your success moment as a developer, a borrower, property professional, effectively is aligned to the lender's success moment, where they get repaid following successful completion of that project. So, we as a lender are incentivized to make sure that you're going to be, the lend to you and underwrite the case such that you're going to be successful in that project. In the same way that, you as a borrower would need to make sure that we're good for the money that we're going to give you, because if for whatever reason we aren't, or you don't think that we are, or the relationship's not strong enough, then ultimately you then run a liquidity cash flow risk during the project, and you'll never be able to exit it. So that kind of relationship is symbiotic between a customer taking drawdowns and a lender providing drawdowns. And so we do have going back to the point you made, we do have and we do want a very strong relationship with our customers on drawdown loans, because we effectively we're almost their majority business partner if we're doing 75% loan to cost. So we've got to know that our business partner is going to deliver the project successfully, and therefore understanding them and their background and their capability of delivering successfully is massively important, which is why we try our very hardest to get to know our borrowers doing refurbishment projects, development projects, as much as we possibly can.
Amazing. And obviously with that relationship that you have with your customers at the moment, I'm sure you get to see a side of what their pain points are, what they're going through at the moment. And one of the things that I'm hearing a lot is that there's quite a lot of applications going through at the moment. So the builds have been quiet recently, but that seems to be ramping back up. And you guys are expecting extremely busy periods over the next few months, next year, based on the amount of applications you're seeing. Is that right?
Yeah, it is. We've seen a material increase in business throughout 2024. Q2, which was April, May, June, was our busiest ever quarter. I think, including further advances, we did something like 310 transactions in a quarter. And then we surpassed that in July, where we did 120 transactions in 1 month.
Wow.
I think August was a bit quieter, but we are expecting that September will be the busiest month we've ever had as a business, and that will then grow into Q4 of October, November, and December. So there's definitely an awful lot of activity at the moment. Confidence is starting to grow on the back of interest rates having stabilised and then obviously having come off last month. Personally, I think that interest rates are going to come down quite quickly because of the challenges around the strength of the economy in the US and uncertainty in the US. The pound is getting much stronger. There is inflation seems to be a bit more under control. And in terms of sort of impacting us as an economy, we can't allow the pound to get too strong because it hits our export market. So therefore, by interest rates having come down, it leads to balancing that. Now there is uncertainty at the moment around what's going to happen in the October budget. I think the certainty is we're going to get hit quite hard, but the uncertainty is how.
Yeah.
Is how. But I'm very much hoping that what the new government have been talking about in terms of supporting businesses, that's going to ring true in some way, shape, or form. What that looks like, I don't know. But I hope that business and entrepreneurs are supported, because the only way in which we're going to be able to create the 1.5 million homes that they're talking about during next Parliament is if there's incentives that are given to property developers. And so, now is a time of uncertainty. The budget that's in October, so some people are delaying, other people are saying, do you know what? Now, volatility leads to opportunity.
Yeah.
In times of volatility, you can negotiate prices harder because there's less buyers and there's uncertainty around what will happen. So whenever there is volatility, creates opportunity and better buying opportunities. So we're seeing, actually, believe it or not, that the entrepreneurs are doing business now before the budget.
Great. And you're optimistic post-budget, would you say?
I hope so. I hope so. I worry at some of the things that have come out over the past couple of weeks or so, but I hope that they are they are being more negative than they're going to be in the budget. I hope.
Right. Yeah.
And property, you can kind of see that, if they open the they've got to support the property market because we have a housing crisis. So how they do that to get the nation building, we as a business are set up to support that, but they've got to provide the framework for people to go and get on with it, entrepreneurs to go and get on with it.
And I saw obviously the base rates come down to 5% this month. Has that had an impact on you guys? And are you seeing that almost give a bit more consumer confidence back to your customers?
Yeah, what we look at is what's called yield curves or swap rates. So, and the best way, and that wouldn't mean very much to lots of people, but ultimately what that means is the pricing of fixed rate mortgages. And we're starting to see that, pricing of fixed rate mortgages is, 3.7, 3.8, 4%. So the expectation is that base rate's going to come down. And so that's being priced into the fixed rate products that are around at the moment. And if we think back to, if we think back 12, 15 months, the fixed rates were, 5.5, 6. So it gives you some kind of indications to the direction of travel.
Yeah, it's moving quickly.
It is, and I think that part of that is a result of the unemployment figures in the States, and so they need to reduce interest. The Fed needs to reduce interest rates to stimulate their economy. They've got an election in November, and you've got two real extremes of candidates that are standing for that election. So that's a time of material uncertainty. So the Fed really needs to do something to kickstart that economy to avoid there being a bloodbath in terms of jobs.
Definitely. And you mentioned earlier that you sort of cover a sort of broad spectrum of customers in terms of, sort of landlords right up to full-blown developers. Are you seeing a particular strategy that your customers are coming to you for? Is there something that seems to be quite prevalent at the moment?
It's a really good question. If I look back over the past 10 years, we've seen sort of different trends and different patterns. So 5 years ago, we had a real mix of customers from property professionals, which can range from people that are professional property flippers to professional landlords to people that are trying to create passive income through property. So and then professionals in other fields. So a lot of doctors, dentists, lawyers, pilots, surgeons, finance directors, IT people that are high earning and trying to create other income from spare money. As a result of rising interest rates between December 21 and August 23, because obviously it went up very quickly, we saw less of those types of people, and we saw more of the property professionals that live, eat, sleep, and breathe property. So builders, joiners, carpenters, plumbers, electricians, ground workers, quantity surveyors wanting to get in, because a lot of you doing some of the work yourself, you can actually save on cost of materials and cost of labour. Whereas if you are working in another field, you're then reliant on other people delivering the project for you. So that leads to higher costs. And if you could get 6.5%, say on a gilt, which is tax free, therefore sort of 10% gross. Why would you want to do property when you can earn 10% gross or the equivalent 10% gross on a gilt? Didn't make sense. So you saw that side, those customers sort of fall away between December 21 and August 23. We're starting to see some of those people come back into the market now that base rate is expected to fall. So it's come off a bit and they expect it to fall further.
Okay, great. Guys, if you've got any questions, do please put them in the chat. The chat is open, so you can put your questions to myself or Scott. It'd be great to see what you guys have got to say and what your experience is on the ground. So Scott, yeah, in terms of I guess within your role, running Roma, you're always kind of looking down the track to predict what's going to happen. We like to keep these webinars as positive as possible, but is there any sort of risk analysis that you're doing, sort of whether it's geopolitically or just, sort of domestic politics that you're sort of keeping an eye out for that could potentially cause a problem for us coming down the track, or is it mainly just the October budget that seems to be the one to err with a side of caution over?
I don't know how kind of far to go with this, because I could talk forever about geopolitics, the threat of Iran, the threat of Russia, the threat of China, the threat of North Korea. I can talk for hours and hours and hours about those threats. If there is a Trump presidency, I think the likelihood of a targeted regime change in Iran increases.
Right.
It's arguable whether that would lead to, I think it's arguable whether that would lead to long-term a more stable West, a more stable, a global economy. Short-term, it would definitely lead to some challenges. I think that there are Iran I see as the biggest threat to global economic stability at the moment. I know people talk about Russia, but Iran is the big problem because it acts through proxies in Western countries.
Yeah, and obviously
as well as in the Middle East. So I could talk for hours and hours and hours about Iran. I won't go any further than that. But there is a risk of a conflict with Iran should there be a Trump presidency, and the UK would get drawn inevitably into that. I think that Russia-Ukraine is a contained war. China is a threat in terms of espionage, but there is just generally a shift at the moment of wealth from west to east. Having said all of that, the reality is, if you look just at the UK, there is, and property, there is a material shortage of residential homes for people to occupy. So from a property, from a simple business perspective, the next 5 years could be incredibly exciting for those people involved in property.
Well, I was going to bring it back round to a positive question, Scott.
Yeah.
But Will has actually put a really interesting question in the conversation. So I'm going to just steer it quickly back to that, and then I promise we will get
Sure.
something more lighthearted. But I found it quite interesting because that's not something you really hear on the news. But it makes a lot of sense, because obviously with Putin, he might be a despot, but he's stable within his position, whereas Iran are going quite through the motions of a leadership challenge at the moment. So it's so uncertain what's happening over there, and as you say, it has a massive effect on the rest of the world. But yeah, to go to Will's question, he's put, Scott mentioned negative news stories he's recently heard regarding the budget. Can he explain also, is there a massive skills shortage in property construction, etc.? How concerned are you both with this, and what would you likely see to change?
That's a really good question. So let's just kind of so the government's announced that we need to build 1.5 million homes. Okay, so we need to go and sort out the planning system. Okay, I don't know whether you've ever tried to find a builder or a roofer or a plumber or electrician to do work on your house, but it can be very, very challenging. So if we try to build these 1.5 million homes and we sort out the planning system, where's all the labour going to come from to build these 1.5 million homes? Where are all the materials going to come from to build these 1.5 million homes? And we're not going to solve the shortage of labour unless we, ramp up the young people that are being trained, or we go and bring a load of immigration into the UK, which has got its own challenges politically and sensitively at the moment. But we're not going to solve that unless we start training more young people to be plumbers, electricians, builders, carpenters, etc. So big issue. So if schemes are approved, it is likely that we will see an inflationary impact on wages within the construction sector, because there isn't going to be the new people coming through as quickly as they're needed, number one. The second piece is, where are all the materials going to come from to go and build those houses and those homes? Brexit has had a material impact on getting stuff into the UK, made it more expensive, it's made it more difficult, because it's put the barriers up. And we obviously we're a big importer of materials. So if there's massive demand once again with a shortage of supply, like we saw during COVID on materials, that is also potentially inflationary on materials as well as on labour. And if then we do manage to build all those homes, okay, so the housing shortage is then resolved, so you've got a massive increase in supply. When you have a massive increase in supply and you've got stable demand, that then reduces GDVs, it reduces values. Because then, it then becomes a buyer's market rather than a seller's market. So actually, from a margin perspective, if everything green light's given to loads and loads of schemes, there aren't materials, there aren't the labour. But even if we solve those problems and they're then delivered, that can lead to falling GDVs, falling rents in the rental space. So going back to what I was saying right at the very start, it's very important that the foundations are laid, in my opinion, in the budget in October that means that developers are supported such that the future risks of pricing, of rents, of inflationary risks on labour and materials, that those risks are mitigated from a developer's perspective. It's not going to be a short-term problem, but you can see that in 2, 3, 4 years' time, it could be a problem. I hope that answers Will's question.
Definitely.
It's not positive, but sometimes you've got to be. That's reality.
And I think Will's saying he's from the Western North Yorkshire Chamber of Commerce. So, Will, great to have you with us. Thanks very much. And Mario's at the back post, steering it nicely into positivity back again. So I don't know if you can answer this one, Scott, but we'll give it a go. So with your sort of comments about labour shortages and material inflation, are you seeing from any of your customers innovative strategies to try and overcome this at the moment?
Yeah, we absolutely are. So going back to what I was saying right at the very beginning, in times of volatility, that creates opportunity. So volatility leads to opportunity. And right now it is a buyer's market. And you buy when everyone else is trying to sell, and there's lots of people trying to sell at the moment, particularly private landlords. So there's a deal that I was looking at before this call down. I won't say exactly where it is, but we've got a customer that's buying a multi-unit freehold block for just under £2 million, where the separation value, once on separate titles, is 3.5 million. So, a vendor's owned it for a very long time. It's under rented, needs some, a bit of TLC, does the property, but the separation value is materially higher than the purchase price. So right now, and the guy owns it in his personal name. There's a charge to an existing another lender, so he's not able to offset the interest costs on that mortgage anymore because of how things are changed from an income tax perspective. So the vendor wants out. And there's cream in the deal for someone coming in. So every business, and it doesn't matter whether you are, buying bricks or whether you are, like we do, we buy money and we sell it at a price that's higher than what we pay for it. It doesn't matter what business you're in. Every business is all about buying well. If you can buy well, you can sell well, and you buy better in times of volatility.
Great. And would that be your message to sort of younger developers or lesser experienced developers that are coming into the game at the current moment, that volatility creates opportunity, and to explore that as much as possible?
If you think that, as interest rates come down, more people will go back into the market to try to buy. Well, that increases competition, so it makes it much harder to negotiate harder. So, so absolutely, you do your best business. You do your best business in what I call a counter-cyclical environment.
Amazing. Right, Scott, thank you very much for your time. I really, really appreciate it. Thanks for joining us this afternoon. Roma has been a partner from almost day one of UK Homes Network and has been so involved in everything that we've done and helped promote the platform. If you want to carry on with the conversation with Scott or anyone from the Roma team, weekly they're uploading case studies from customers of how they've overcome certain situations. They're showing really insightful content. You've also got your own podcast with Michael, the commercial director, which I was lucky enough to be invited onto. So if you guys want to check that out, it's on YouTube. If you search Roma Finance, it comes up straight away. There's some great episodes on that. Scott's on there as well. So yeah, guys, if you want to check out any more from Roma Finance, please do check them out in UK Homes Network. It's free to create a profile and sign up. But if they want to come to you direct, Scott, and find out a little bit more about the lending opportunities, obviously your motto is love to lend. So if they'd like to find out a little bit more about that, where can they find you?
Yeah, so the phone number is 0161 817 7480. Website is romafinance.co.uk. And our email address is enquiries@romafinance.co.uk. And as you quite rightly said, we love to lend. That's what we do.
Amazing. Well, thanks, guys. Thanks for everyone who's joined us today. If you want to watch the recording back, it will be available in the UK Homes Network platform. That's all from me. Thanks very much, Scott. And hopefully we'll see you on the next webinar.
Look forward to it. Thank you, Chris.
Cheers,
Bye-bye.
guys. Take care. Bye-bye.
Bye.